Hello everybody and welcome to this video entitled The Best 10 Stocks in My Portfolio. I hope everybody had a great Christmas and a great holiday, and we have a few trading days remaining in 2023, and I figured this was a good day to make an update on my valuation spreadsheet of the top 10 or the top 10 best stocks in my portfolio. I've changed a few things and I'll get into it in a second. Before I do, if you're new to the channel, welcome. This is a spreadsheet that I update about every 2 weeks to my viewers. I give this update. And the main goal of this spreadsheet is to give out this number, which is enterprise value over gross profit over revenue growth. What is this number? This number is a modification of the PEG ratio, the price to earnings to growth ratio of Peter Lynch, but I've modified it and I don't use stock price, right? I don't use market cap, I use enterprise value because I want to make sure that I penalize companies that have debt. I use gross profits and not earnings because earnings I view as too easy to manipulate, and I think gross profit is a better indication of the true economic profitability, true margins of the firm, and I use revenue growth, and revenue growth is a proxy for gross profit growth. Revenue growth is a proxy for gross profit growth. The reason for that is because gross profit typically is optimized for the firms that I follow on the channel. I typically will not invest in a firm if it is not at least optimized for gross profit. So that's my style of investing. And all of these companies you will see, all of these companies are hyper growth companies. They're all very early in their journey to dominating their respective industries. And this is because of my style of investing. What is my style of investing? Well, I ride S curves. I ride product adoption curves. I try to go in and buy a stock early at early signs of product adoption. And I try to get out of these stocks, 10, 15 years later when it's very, very clear that their main product has been adopted. And if and then they have not introduced a new product with a similar S curve starting all over, then I get out of the stock, and that's when I pay capital gains. And so I get all of this growth, typically free of capital gains until I sell, right? You only pay capital gains when you sell. So that's the beauty, in my view, of this style of investing. And really briefly, my the returns that I seek tend to be 30% compound annual average growth rate. And the reason for that, why do I seek a 30% CAGR? And typically when these stocks I enter in my portfolio, they need to grow 30% in revenue growth. I made an exception for InMode actually, but all of these stocks otherwise, when they entered my portfolio, they were growing at more than 30%. And the reason for that is because if a stock grows revenue at 30% and the price to sell doesn't change, then the return of the stock for that year is 30%. And I want to grow stock at 30% because this channel is named Beat the Denominator. So the number that I'm trying to beat is 15% per year in nominal returns, because I consider a return of 15% per year to be no return because it doesn't even match monetary inflation, right? I consider monetary inflation to be 15%. I want my stocks to return 30% in nominal terms. And if they return 30% in nominal terms, then I will have achieved a very reasonable, in my view, 15% real return in a year, in 1 year. And so over a 5-year period, that's a 2x. Over a 10-year period, that's a 4x. I consider this type of targeted return to be reasonable, to be more than reasonable in my view. And so let me just get started with a spreadsheet. If you've just come from a spreadsheet, feel free to take a screenshot and do whatever you want with the data. But otherwise, I'll tell you a little briefly what I think of each stock. So the top stock, number one stock in my portfolio, is Tesla. I believe Tesla is the best opportunity in the 21st century, period, second to none. I don't see any other great opportunities. Obviously, I'm not the only one seeing Tesla as this opportunity, and so the stock is a little expensive. But I should note that it's mostly expensive because I'm using revenue growth of 30%, which I copied and pasted what analysts write, and that's obviously, in my view, way too low for a company like Tesla that is going to have near binary events. We know we have FSD coming. When FSD comes, that's going to be a binary event. By a binary event, I mean we're going to get a year where we're going to go blow way past 30% growth, right? The day FSD is sold, you blow way past 30% growth that year, and likely for the next few years. The same is true for the next gen vehicle of the Model 2. When that model is released, the total addressable market of Tesla car triples overnight, and that's an over binary event. Of course, they are more than 1 year out, so no analysts account them. And the same is true for gross margin. I use analysts' gross margin here at 20%. It's not nearly enough. In my view, that gross margin will be much higher over time and as this company becomes a software company. Nonetheless, using analyst number, I am getting a stock that is not too cheap, but in my view, compared to the potential of this company, it is dirt cheap in my view, especially if you start to just even consider the possibility that they may have robots. I mean, it's not. It's a different world out there. And this stock, of course, when you start plugging in gross margin at 27, 28%, and when you start plugging growth rate at 50%, which was the long-term guide for Tesla, you're getting to much more reasonable EV over gross profit over revenue growth numbers. I would put Tesla as one of these special mega cap stocks right now, along with Nvidia. But Nvidia, if I were to put Nvidia in this spreadsheet, it is so nosebleed it makes Tesla look cheap. So just keep that in mind. If one is too quick to call Tesla overvalued, take a look at Nvidia, and then you'll feel very comfortable about Tesla not being overvalued. Anyways, moving on to another stock in my energy revolution megatrend. By the way, this is the megatrend, right? Energy is getting revolutionized in my view. We're moving to a world of oil and gas, from a world of oil and gas to a world of EVs, to a world of electric everything. And the two main agents of change stocks that I have in my portfolio are Tesla and Enphase. And Enphase attacks this energy revolution from another angle, which is powering solar panel, and namely powering the inversion of electricity, the turning of electricity from DC to AC, with a little box that they call a microinverter. And they pretty much pioneered and invented the concept, and they are the leading solar installer for residential solar. And the whole story of me owning Enphase is I view a world where you take a walk in the neighborhood and you have 8 roofs, 9 roofs out of 10 with solar panels. And surely I am in Europe right now, and there's way more solar panels here in southern France than there are in Texas, where I'm located. So I know there's a bunch of growth coming for Texas, a bunch of more growth coming. Just by looking around, driving around here and driving around in Texas, I can tell you it's an easy 3x if it just gets to the level that it is here. And here it's nowhere near all of the roofs. So we have a tremendous 10-year, in my view, runway for adoption of solar, because it's free electricity from the sun. Once you've paid for these solar panels, once they are on your roof, they're not going to move. They have no moving parts, and thus, because there's no moving parts, they last for essentially, I mean, not essentially ever, but they last for way past 25 years. They are warranted for 25 years, but they last for way past that. I have no issues seeing a solar roof last 40 to 50 years. And in fact, we know that because the panels that were installed in the 70s during the hippie movement, and a lot of people loving those panels, some people still have in operation. And yes, they are at 65, 70% of efficiency of what they had back then, but they're still running and they're still working just fine. And that's the beauty of a technology with no moving parts whatsoever. When I look at the price of this company, a little expensive. The reason why Enphase is expensive is because projected growth is only 12% because of the interest rate environment, right? If I were to plug in a 30 or 40%, like it has grown historically revenue, if I were to plug this back in, then we would get a stock that is much cheaper in my view. Let me now move on to MicroStrategy slash Bitcoin. By the way, Enphase is my second biggest stock position, and it is my third largest position if I count BTC, because BTC is my second biggest position, but BTC is technically an asset, right? BTC, Bitcoin is what? It's my bond alternative. I do not own bonds. Proudly, I own zero bonds. I don't want counterparty risk. I have enough counterparty risk with stocks and brokers. It's enough of a counterparty risk. Bitcoin is my second asset. It's my bond alternative. I've been in Bitcoin for I mean it's been a part of my investing journey for 8 years. I really believe in the adoption of this technology. This is the invention of a new asset class. This is the favorite asset class of Gen Z, the generation that's coming, and the generation that's going to take over the working world and the investing world. That generation loves cryptocurrencies more than stocks. They love it more than stocks, and I think it's important to buy the assets that the next generation is going to want. And generation alpha, let's not even discuss. They don't want a $20 bill for mowing the lawn or whatever. They want digital dollars, and they want Robux, and they're used to having everything digital. So it's so obvious to me in my mind that currency will move digital, and if currency moves digital, well, you need a native currency for the internet, and to me, Bitcoin is that native currency. Bitcoin is as pure of a network effects play as it gets, right? The more famous it gets, the more people adopt it, the more value of the network goes up, and I'm very happy to own it, and I sleep well at night with it. Noteworthy to say is that Bitcoin is having the halving in April. So in April, newly issued Bitcoin, the Bitcoin that is issued every 10 minutes, it's going to move from 6 Bitcoin every 10 minutes issued by the algorithm to 3-ish Bitcoin issued every 10 minutes by the algorithm. So technically, theoretically, if you do the calculation and the domain doesn't change, you should have a 2x technically. And then with the ETFs coming and the adoption of Bitcoin ETFs coming, who knows how high of a demand could be. This is Bitcoin to me is of course an extremely long-term hold. I don't hope to ever sell my Bitcoin. This is not in my interest. I would much rather borrow against Bitcoin, and that's, if you meet people who have gone deep into the Bitcoin rabbit hole, that is what they will do. They will borrow against the Bitcoin, and sure enough, that is how the fiat system works and has always worked. And as long as we live in this dual system, which I believe we're going to live in this dual system for a while, as long as we live in this two system, fiat and Bitcoin together, or fiat and crypto together, you're going to have the possibility to borrow in one currency and or hold another currency. So I'm very bullish on this. I realize this is a channel mostly about growth stocks. Some people may not always agree with me on this one. That's okay. Disagreement is the point of innovation, because we can't all agree, right? I mean, we can't all agree on a 10x. If everybody agrees on a 10x, then it's not a 10x anymore. At least it's my view. Next stock that I like, that is a big position in my portfolio, is Hims and Hers stock. What is Hims? It's the way I summarize it is it's an e-doctor plus an e-pharmacy without insurance. So digital doctor, digital pharmacy, no insurance, and they focus on recurring revenue. So they have chronic conditions where people need to take medication, pharmaceuticals on a regular basis, typically every month. The average bill that Hims charge for a treatment, let's say a hair loss treatment, for example, the average price is about $50 to $60. And they have more than 1 million subscribers, and the service is growing very fast. Revenue growth is 60%, predicted to be 60% next 12 months. And if I look at the valuation, it is the cheapest stock in my whole portfolio. Hims is suffering from the SPAC curse. That is the only rational explanation, in my view, as to why it's so cheap. It's suffering from the SPAC curse. It used to be a SPAC, and so the market has said SPAC equals bad, and they've sold off Hims, even though the company keeps outperforming other players in the space like Teladoc. And if you look at their performance, say on the App Store, it's outstanding. The app is doing so well, and I believe they have a truly different truly 0 to 1 one value proposition that you can't find in the other players. And so I'm very happy to own HIMS for that reason. The next company that I own is CrowdStrike. So CrowdStrike is, in my view, the winner take most or the winner take all a player in endpoint security. So what is endpoint security? It's what I jokingly call an antivirus on your endpoint. What is an endpoint? It's a laptop, a phone, a car, a terminal of some kind, a tablet, you name it. That's an endpoint. And so CrowdStrike has a software called Falcon. Falcon is a cloud-based software. And whenever someone using a laptop or a phone somewhere gets a breach, right, a breach, an attack, a virus of some kind, CrowdStrike um, captures that breach, and notifies and updates the entire network. Hundreds of millions of devices get updated whenever one device on the network is breached. So all of these devices are on the CrowdStrike network, and you can understand why this is necessarily a winner take most market. Because if you want the best security, you need to be in the network where that breach is going to happen, and that breach is likely going to happen on the biggest player. So because they are the biggest player, they can update the antivirus the fastest through the cloud. And in a nutshell, that is how CrowdStrike, in my view, is winning in the marketplace. I realize it's a very simplistic explanation, and if you're in IT, don't go yelling at me in the comments section, but that's how I rationalize it in my brain. A little pricey. CrowdStrike is a little pricey, but it's a stock where we have long-term guidance. We have 7-year out guidance with CrowdStrike, so that removes a lot of risk, and that's why it's a little pricier. When companies give very strong long-term guidance, they tend to be pricier because there is less uncertainty, right? That's the reason why Tesla is pricey too, because Tesla has given us a very bold guidance. We have Elon telling us 20 million by 2030, 20 million car and 5 trillion in market cap, 5 trillion in market cap. That's what's been guided by the CEOs. CEOs they have a fiduciary duty. So when they guide this, that's going to remove a lot of risk, and that's why people buy these companies. And I like that I have long-term guidance for CrowdStrike. Anyway, that's my cybersecurity play in this 10 best stocks, in the 10 best stocks in my portfolio. Mercado Libre, there's nothing to say about Mercado Libre. They are the leader in Latin America. They are the Amazon of Latin America without the cloud. So they don't have a cloud division, but they have a payments division for micro businesses and for paying on their platform that is very popular. Mercado Libre, penetration of e-commerce in Latin America is still earlier in the US. I would argue by about 10 years. It's earlier by about 10 years. So you get to ride that growth in Latin America. And I love to invest in Latin America. It's a market that I understand much better than Asia, for example. And I think it's much more similar to Europe and to the USA. And so I'm more prone to understanding the shopping habits and the payment habits of places like Latin America. And I mean, it's as steady eddy of a stock as it gets. There's really no bad news ever on Mercado Libre. It's like it's a sleepy stock. I mean, it's a sleeper stock. You can just sleep on it. And I believe it's very cheap right now. At a 0.31, this stock is still cheap compared to the other stocks in my spreadsheet and compared to the upcoming growth. Keeping in mind that a stock like Mercado Libre still has advertising. If you follow the e-commerce space, the big deal in e-commerce right now is advertising. Having sellers on your platform advertise, and they're implementing advertising, and that's going to be a cash machine for them. Look at that gross margin, 57% gross margin. How much higher can they get? Can we get to 60, 65% gross margin? I mean, to me, this is a great company to own. I'm very happy to own Mercado Libre, and I sleep well at night owning that stock. Let me move on with StoneCo, Stonier. So Stonier and or StoneCo. Ooh, I have a problem with my StoneCo in my spreadsheet here. Okay, I will. I have. Yeah. I did not update StoneCo properly in my spreadsheet. So if you want to see the valuation for StoneCo, please look at my video from 4 days ago where I covered StoneCo with an updated valuation. I'm sorry about that. Anyways, StoneCo, what is the advantage of what is StoneCo? So StoneCo is actually the second cheapest stock in my spreadsheet. It traded at a 0.07 ish is what it trades at. It's still a dirt cheap stock. StoneCo is the Square of Latin America, the Square of Brazil, and it is a stock that is still heavily undervalued, and they have more than 3 million small businesses in America using their payment terminal, right? And that's not Latin America, that's Brazil, and Brazil is filled with small businesses. It's a highly small business oriented type of country, and they all use StoneCo. At least StoneCo is the leader, and PagSeguro is a close second in my view. It depends depending on the stats you look, because technically StoneCo focuses on small businesses that are still small businesses, but still a little bigger than, say, micro businesses. Very interesting space. I've covered StoneCo so much on the channel. Sorry about that. This whole line is wrong. So sorry about that. Let me move on to another stock. So this is Shockwave Medical. So Shockwave Medical is a stock that I've added recently. Of note here, I call these my bonus stocks. The reason why I call these bonus stocks is because I used to have SoFi and I used to have Nubank in there, but I don't want to cover SoFi and Nubank with this ratio anymore. EV over gross profit over revenue growth. I do not think this is a ratio that I can apply to banking stocks or financial services stock that engage in lending. I don't think this ratio works for that, and I've been using it for a long while, and people have been kind enough on Twitter to show a few things to me, and so I just don't think this ratio can work for banking stocks. Banking stocks need to be analyzed with a different lens, so that's why I've removed banking stocks on there, and I'm really only using stocks that fit this ratio. Anyways, there's two of them. Two, I'm gonna calling those bonus stocks. I'll have to see how I I'll have to update it and include stocks within megatrends. But I call these bonus stocks. You could look at those as medical devices stock. Really, I should have named this medical devices stock. So Shockwave. What is Shockwave? Shockwave is a stock that fixes your arteries with sound waves. It's a new technology that helps with atherosclerosis and heart disease, and it fixes calcium deposits in your arteries through shock waves that are sound waves, and that's a up and coming medical technique. But the point is, the reason why I love Shockwave Medical is it's a cheap stock at a 0.24. It's in a sector that I don't have much exposure to, which is the medical devices equipment. I still have, I don't want to call it stigma, but I still have pain from missing intuitive surgical, and I'm kind of looking for my next intuitive, and that's why I have Shockwave and I have InMode in there, because I do hope to find my intuitive surgical at some point, and I think Shockwave or InMode could be stocks that are close to that. If you look at the revenue growth, it's outstanding at 57% revenue growth by analysts, predicted by analysts over the next 12 months, and the forward gross margin is 87%. So 87% gross margin. This is almost pure gross margin type of business, and I believe this company is doing very well. I've listened to the conference call multiple times. This is mostly when you bet on these medical devices, you're really betting on two things. You're betting on the aging population, which is a certainty that more and more of these procedures for atherosclerosis, which is heart disease, right, are going to be needed. That's a certainty given the aging demographics. That's for one, and then you're betting on the medical reimbursement system, the insurance system. In the US, for example, it's Medicare. You're betting on these systems to reimburse the procedure, but because the procedure has outcomes that are 100% better than what has been done in the past, and because the procedure is backed by publications and medical societies who say, oh, this is much better, it's going to be reimbursed. but it just takes a while because you have to deal with a lot of red tape, you have to deal with a bureaucracy. It takes a long, long while to get these procedures reimbursed. But I believe it will be, and this is a stock that I find very compelling. I've done a full video about it. You may like it, you may not, but that's a bonus stock in my. And by the way, these two are not my top 10. By the way, these two are not in my top 10. I've put them just as placeholders to replace SoFi and Nubank. SoFi and Nubank are in my top 10, but they can't be analyzed this way. So just saying that. The other one is InMode. I've covered InMode recently. InMode, I've had it because what is InMode, by the way? InMode is a hybrid between a laser procedure and a surgical procedure for cosmetics. They're a cosmetic procedure company. They use micro needling techniques to tighten skin. They're a skin tightening tech. Anyways, what is the mega trend that you buy when you invest in a company like InMode? Well, you bet that the Instagram movement, the Instagram trend is going to keep going, and you bet that the Instagram users are, slowly aging into their 30s, and they're going to be getting these expensive procedures in order to still look good in their pictures, essentially. So that's essentially the thesis behind investing in this stock, and this stock is dirt cheap. I mean, look at this. This is trading enterprise value over gross profit is a 3x times gross profit is what the stock InMode is trading at. So that's a very, very cheap company, and I'm very happy to buy it and own it at these levels. The last stock in this spreadsheet that I'm going to cover is Airbnb. Airbnb, I seem to be the only one to like. Airbnb is the leader in short-term rentals and short-term accommodations. They are still competing with hotels, and I should really say taking market share away from hotels. It's a complex company to tell you about in a few minutes. But in a nutshell, what Airbnb is doing is it's a platform that doesn't own any physical buildings or any brands or any hotels. And as a result of that, it can grow much quicker than, say, hotel chains, and it doesn't need the capital of hotel chains, and it resonates with a lot of the Gen Z. This is all a part of a company that's getting adopted by Gen Z, and you have a bunch of Gen Z whose main habit when they want to stay somewhere is to pick up the phone and look at Airbnb and choose an Airbnb, right? You have people who use Airbnb as a noun. You say, oh, I'll just stay at the hotel. And no, you don't say that anymore. Now you say, oh, I'll just stay at an Airbnb. I'm telling you how it is in the US, but it's actually very popular in Europe too, and it's becoming more and more popular because it is the best. It is a best cost product, right? If you travel as a family, it's much cheaper. If you travel for authenticity, it's gonna be better. And there's a lot of FUD on Airbnb and Wall Street. Like the big one is, oh, they're gonna get banned. But we know that whenever a city bans Airbnb, what's the next thing that happens? Well, the city next door doubles the business, right? That's what happened in New York City when they banned Airbnb. All of the cities surrounding certain New York City doubled the business. Complex business to discuss in just a few minutes. I've done full videos on my channel dedicated to Airbnb, and I hope you'll take a look. Thank you so much for watching this video. Thank you for watching my channel. This was not investment advice. This is just entertainment. I hope you're still enjoying your holidays. Please like, please subscribe, please follow me on X at Bitcoin Dominator. No financial advice again, and have a wonderful, wonderful day.